Awesome. Thank you, Brianna. And thanks everyone for being on today. I've also got Claire, our events director, helping me out. She'll be watching the chat as well as the participants window. So if you do have any questions as we're talking today, please do feel free to throw those questions in chat or raise your hand in the participants window so that we know you've got a question, and Claire will interrupt me and we will get to your question as we go. So I do encourage questions as you think of them. That way we can answer questions as they come up. So I'll spend a little bit of time just quickly giving some initial data around what due diligence means to different people, why people do due diligence, and what they get out of it. So I'm going to launch a poll here. So if you fill out this poll, just let us know kind of what benefits do you see due diligence providing. This kind of helps us tailor the due diligence process to make sure that it's useful for everybody. And as you fill out that poll, I'll share a little bit of data from a survey that we sent out. The survey is a little bit outdated now. It probably went out about 6 months ago, but essentially asking some of our frequent participants of due diligence what they get out of it, why they participate. Unsurprisingly, perhaps, about half the time they're considering investment in a company. And half the time they're really doing it for the network effect, getting to meet other people, getting to be a part of the community, helping others evaluate an investment opportunity, even if they themselves are perhaps not considering it for themselves. And I think this is really true anecdotally as I've talked to people. A lot of people do use due diligence as a tool to evaluate companies and decide if they're a suitable investment. And after all, that is what due diligence is for. But I think it's equally important to understand that due diligence has a lot of other benefits as well. You're able to give back to the community, you're able to meet new people, you're able to learn new things, you're able to build your professional network. And the more companies that you see, the better your gut check becomes when you're seeing new companies in the future. So definitely a lot of benefits around why we do due diligence here at Keiretsu. Obviously, of course, though, we wouldn't be doing due diligence at all if the numbers didn't tell us to, if we weren't looking at companies and trying to increase our investment returns. And so I want to spend a little bit of time talking through some of the angel returns data that has come out really over the last decade and a half or so. These graphs in particular that I'll run through over the next few slides came out of a 2007 study published by Robert Wiltbank through Angel Capital Education Foundation and the Kauffman Foundation, gathering a lot of data from a lot of different angel groups, a lot of different investors, just really understanding what the impact of due diligence is on angel returns and how we can influence angel returns. The studies have been updated over the years, and so these numbers have changed a little bit, but still a lot of these guiding principles hold true. So just to start with this data here, the biggest thing that I want to get across to everybody is that the more due diligence we do, the better our investment outcomes should be. This is characterized both by fewer failures, so your failure rate dropping from about 65% to about 45%, as well as your success rate of those home run exits going from about 0% to about 8 to 9%. So a dramatically lower failure rate, actually getting below 50%, so more likely than not having companies have some sort of a return, which is fantastic, as well as opening up the possibility of these home run exits that really make all of these returns work. If we break that down a little bit into the exact amounts of due diligence that people should be doing, one thing the study looked at was the amount of hours that investors spent doing due diligence. The average was something like 60 to 70, the median was about 20. For those that did less than the median, so that is less than 20 hours of due diligence, you're basically getting your money back. This is about a 3 to 4% IRR, depending on how you calculate it. So you're better off just sticking your money in an index fund. Where you really start to make your returns as an angel investor is when you spend the time to get to know your investments and invest responsibly. So a high amount of due diligence, categorized as doing more than 20 hours of due diligence, gives you about a 6x. So pretty good IRR there. And in fact, if you're in the top quartile, doing more than 40 hours of due diligence, you're looking at about a 7x or greater. So definitely a lot of returns to be had from being able to spend the time in due diligence. This, I think, carries through well. Again, looking back at the survey that we sent out a few months ago, we see that on average, Keiretsu members on a diligence team spend anywhere from about 10 to 40 hours conducting due diligence as part of a team. And this is really the benefit of the team environment and why we do due diligence as a group. Rather than any one person having to spend those 40 or more hours to get good returns, we're able to distribute that out. If we have, for example, 5 people, and each of those 5 people do 10 to 20 hours, now as a group, we've done 50 to 100 hours of due diligence on the company, and that's going to help push us up to that upper bracket of returns. One of the biggest benefits of due diligence is really just a filtering mechanism. Every company has risks, of course, in the startup space. And so part of due diligence is just understanding what those risks are so that you can then decide for yourself whether the reward potential matches with the risk potential. About a third of the time, we see that investors do invest after completing due diligence for those who are active within the due diligence community. But certainly, it's also an acceptable outcome to go through due diligence and decide that the company is simply too risky for you or at the wrong stage. There's obviously a number of reasons that you yourself might be passing on an investment. A couple of other things that I want to hit on as we talk about due diligence and how we can influence higher returns and better due diligence. Expertise is a big one. So having some industry expertise. So if you're evaluating a software company, having some software experience. If you're evaluating a pharma company, having some biotech experience is really going to help drive those returns as well. Really what this comes down to is your gut check is going to be better. If you understand the industry, you understand the pitfalls to look out for, you understand where companies can go wrong, and that's going to help you identify those issues and work around them in due diligence. So again, we see failure rates dropping from about 60% to a little over 40%. We also see home runs increasing with the more industry expertise that you have. Again, one of the benefits of working in a group, even if you lack the experience in a particular area, by working with a group of other investors, hopefully somebody else has that experience. And so you're able to really blend your skill sets together very nicely. Participation is also very important. And I want to hit on this because what we're going to talk about today is very much due diligence, what you do before you invest. But I don't want anybody to neglect what happens after you invest. And this is why it's so critical to stay in contact with your companies, continue to communicate on an ongoing basis, serve on the board if you can, be an advisor if you can, connect them to other resources, connect them to other investors. That's going to also decrease your failure rates, increase your win rates by participating with them on a monthly basis instead of on a yearly basis. Communication is really important. And that's definitely been something I know Brianna's been hitting on this year, communication, communication, communication. So the first thing that I'll talk about when it comes to due diligence is just setting some groundwork for the stages of due diligence that we can expect. And these are roughly the stages that it breaks down to here within the Keiretsu process. So hopefully, as many of you know, our first look at a company is really deal screening. And that occurs before the roadshow. It's our first look at a company, just to understand if we might be interested in learning more. The company then comes through roadshow, and that roadshow really kicks off the start of our formal process. It's a week-long, 6-chapter meetings. A company presents to all of our investors in the network. And that's really about showing investors that there's something there to conduct due diligence on, getting investors interested to conduct due diligence. From there, as many of you may have experienced, the company spends about a week or two building their due diligence team, reaching out to investors who've expressed interest, understanding why they're interested, what they look for, where their interest lies, and solidifying who wants to be a part of that due diligence team going forward. From there, we roughly target about 6 weeks to do the substantive part of due diligence. Now, sometimes it takes longer, sometimes it's shorter, but we try to keep things moving forward as best we can. The first half of that substantive phase of due diligence is really just a lot of deep dives, really just digesting a lot of information. It's sort of drinking from the fire hose for a lot of investors as the company just keeps throwing information at you. Once you've got all of that information together, now you can start asking intelligent questions about the information you've received. And that fundamentally is the power of due diligence. Not just getting information from the company, but being able to probe that information, ask questions based on your experience, bring in experts to evaluate the information. And so that's really the bulk of due diligence, is just asking questions. At the end of the process, then we do want to publish a report. So that is our expectation of anybody who joins a diligence team, is that when it gets to the end of due diligence, that you contribute something to the written report. That can be 1 page, it can be 10 pages, it can be 100 pages, really whatever you're comfortable with and that conveys the information that you've learned during due diligence. So you've asked questions, you've digested information, and now you summarize those findings in a written report that can be shared with the rest of the network, shared with other investors to share your knowledge. After all, you're now the expert in the room.
Hey, Nate.
Oh, yeah, go ahead.
We have a quick question from Dwight in the chat window. What's the DD consideration for proprietary and confidential disclosures, especially in the areas of intellectual property protections and pre-patent situations?
That's a fantastic question and very timely as well. So as we're writing that report, and in fact, as we're going through the entire due diligence process, confidentiality is definitely something that you want to be able to set the groundwork for up front and then be respectful of throughout the process. In general, the reports are non-confidential. They are not protected under NDA. So anything that requires an NDA, keep it out of the report. I also typically do not sign NDAs because I see so many companies. So don't talk about confidential information around me either, unless I have to, and then we can work it out. In general, most DD team members do not sign NDAs. So the weekly calls that we have as part of this due diligence process should generally be focusing on non-confidential information. And for those team members who do sign NDAs to look at more technical information, you would have separate calls with the company to go through that information, synthesize it down into something that can be shared with the broader network. From the company perspective, of course, I always say, building a company is 99% execution, 1% idea. So there are some very valid concerns when you're sharing trade secret information or highly technical information that would be very damaging if it gets to a competitor. And we absolutely understand the need for NDAs in that area. Certainly though, when it comes to things like financial data, sales traction data, those areas we typically don't see NDAs being signed just because that information is so readily available. So as that kind of winds down the process, we get to the point where we're publishing a report. From there, it's really up to the company to syndicate it out to the network. We hold a number of calls to kind of keep things moving along. But that really highlights the process, I think, very well. So to break that down a little bit, the first thing that I like to talk about is on this slide, we've kind of mapped out this 6 to 8 week process. And again, sometimes it's a little bit shorter, sometimes it's longer. It really depends on how responsive the company is, how motivated investors stay, how many questions need to be asked. And so this is what I always like to tell investors when we're starting a due diligence. Never sacrifice the quality of due diligence just because of time. But be aware of how much time you're taking up, be aware of the types of questions that you're asking. And most importantly, if there are sort of deal killing type questions where if you ask a question and you get a bad answer, you're going to throw your hands up and walk away, ask that question first. Don't wait until hour 40 of due diligence to ask the question that makes the previous 39 hours a waste of time. There's always an opportunity cost. And when you're a founder raising millions of dollars, that opportunity cost is in the thousands of dollars an hour. Now, that's not to say that if you do due diligence, you have to invest, but you should be adding value approximately commensurate with the amount of the entrepreneur's time that you're taking up. And vice versa, the company needs to be responsive to investors' questions, again, respectful of the investor's time and the fact that investors could be looking at many deals. So there's a bit of a give and a take here, but definitely something that I want people to be keeping in mind as we go through due diligence. As we're building that diligence team, so this is sort of the start of the due diligence phase. An ideal team is going to have about a half dozen investors or so. Of course, more voices in the room help provide a diversity of opinions, and many hands make light work. Teams can be done with fewer, but I find that 5 to 6 investors is a pretty good size for most due diligence teams. These are kind of the roles that we break due diligence into. And I'll go ahead and launch another poll here. Just let us know kind of what areas you're interested in learning more about through due diligence. Again, this is going to kind of help us craft future training materials as well. So I'm always curious to know what topic areas people are interested in. And I'll break these down a little bit more as we go through. The first thing that really kicks off due diligence is the kickoff call. So this is the very first group call that everybody has together as we talked as a group. Most of these kickoff calls move pretty smoothly. We have a round of introductions. This is that community building aspect where we have a chance for investors to introduce themselves, listen to others' introductions, have the company introduce themselves, really understand who we're going to be working with over that 6 to 8 week time period. We'll have the company give some quick updates, remind everybody why you're there, what's interesting, what's changed. And then a lot of that kickoff call is just for some of that basic Q&A to start laying the groundwork for what information you're going to need to get as an investor. And then, of course, there's the housekeeping stuff, setting some timelines, setting some expectations, all of that good stuff. So I see from the poll, we've got a pretty good mix of interest, which is good because I'm going to make you listen to me talk about all of those topic areas. So the first thing that I'll touch on is the sales, marketing, and competition piece. So what do we look at when we're evaluating that? This is the first of kind of 4 broad sections that I categorize due diligence into. The first question that we're always asking is just that business and revenue model question. How does the company make money? What product are they selling? Who buys the product? Why do they buy it? And that gets us to sort of value proposition. What is the company's marketing plan? How are they conveying that value proposition to customers? How are customers receiving that value proposition? Where are customers located? Is the customer sales pipeline legitimate? Really understanding how the company makes money and how they actually act on that plan to bring money in the door. The other big piece of this section is that competitive landscape, understanding the company's product, how it stacks up against competitors, and understanding the different incentives and barriers to entries in the space. One thing that I really like to touch on in the competitive landscape piece is that you have to always consider status quo. You have to consider complements, you have to consider substitutes, you have to consider adjacent competitors. It's not just companies that directly compete. So to use Zoom as an example of that, for example, so Zoom perhaps directly competes with things like Skype and Google Hangouts and Teams. But there's also some other status quo or adjacent type competitors that you might think about. So for example, Cisco conference calls, that would be a competitor to Zoom in sort of an adjacent space. Even things like airlines or trains, you used to have to fly across the country for a meeting. Zoom displaced that. So you really want to understand the competitive landscape of a company when you're evaluating it, understand not just who it's competing with directly, but what other interests might be at play insofar as who it's displacing. When it comes to the financials, terms, and exit piece, this is the second bucket that I categorize due diligence into. There's a few different things that we're looking at. The first is everything that has happened previously, as well as everything that's happening going forward. So when we're looking at the financial statements, the historic financial statements, what we're really looking for is just to make sure that those are reasonable, that the company has told a reasonable story of how it started to where it is now. We want to look for anything like hidden liabilities. I have had situations where there have been, for example, equity miscategorized as debt or debt miscategorized as equity, or there's been some IOUs that aren't on the balance sheet. So you want to make sure you're asking questions around those, making sure that the balance sheet and the income statement are actually reflective of reality. Then we want to look at financial projections, and this is everything going forward. The biggest thing on the financial projections, and the company should be able to provide you with a financial model. You should not have to create a financial model from the ground up. But when you receive the company model, what you want to be looking for is validating the assumptions that are made. So if the company assumes that they're going to grow 5% a year, why is that? Understand the variables that go into that. Understand how the company's overarching strategy plays into those variables. Understand where those variables might go wrong. So for example, if I were to build a projection saying that I think I can hire an A sales team and pay everybody $100 a month, that's an unreasonable assumption to make. And so you might want to flesh that out with the company. Obviously an extreme example, but you can kind of get the sense of what we might look for in this area. The third big piece under the financials review is just understanding the capitalization plan and the financing history of the company. You want to look for any unusual terms in the term sheet, so things that might have an unfavorable impact on you as an investor in the current round, things that might unfavorably impact prior investors, as well as things that might hinder the company's ability to raise money in the future. Valuation is definitely a big part of this. Having too high a valuation early on will make it harder to continue to meet your milestones going forward. But there's a lot of other pieces that go into this other than just valuation. You've got information rights, you've got participation rights, pro rata rights, all of that type of stuff that you want to be considering as well. The final big piece, as I mentioned, valuation and just that exit potential piece. You really want to understand what the exit looks like, assuming the company is successful. We don't want all of our companies to become zombie companies or lifestyle companies. We as angel investors really are looking for that big exit at the end of the company's initial growth phase. The biggest thing that we're looking for when it comes to exit potential, we want to understand, is the valuation today reasonable given the risks and returns involved? And how is the company going to get from its valuation today to its valuation at exit? We're going to be looking at comparable exits. We're going to be looking at revenue models and revenue multiples, really getting a sense of what that exit looks like. I'll move on. Yeah.
Someone asked what a messy cap table would look like.
That's a great question. So a clean versus messy cap table is really referring to just a couple of things. One, the number of entries on that cap table. So a company that has 5,000 investors is going to have a harder time getting things like shareholder consents, having shareholders vote on new terms. If you have to get 5,000, 50% of 5,000 votes is a lot more than 50% of 10 votes. So that's sort of the easy answer, is just the number of shareholders on a cap table. The other thing that you really look for is things like too many notes. So if there's a lot of convertible notes or safe notes outstanding, it's sometimes difficult to get an accurate picture of dilution within the company as those notes start piling on each other. You've also got issues where if you have too many different sets of terms, so if the seed investors perhaps have particular preference rights and the A investors have different preference rights, and then you've got some notes thrown in there, it becomes very tricky to keep track of who actually owns what rights different groups have. And so the simplest thing is just to make sure that everybody has similar rights in the company, that it's very clear, I invested X, I own X% of this company. So the more organized of a cap table you have, the easier it's going to be for future investors to really understand the full picture of the company. All right, I'll move on to kind of the third big bucket of due diligence here. I'm looking at product, technology, IP, all the things that go into what the product is and how the product works. I will mention here, many people will kind of combine product and competition. Understanding the product is sort of pivotal to understanding how the company plays with the broader competitive landscape. And so one of the big things to keep in mind here is these are simply the 4 buckets that I use to sort of explain the process of due diligence, but you can mix and match as much as you want. When we do start looking at the product, the tech, the IP, there's sort of 3 different broad strokes industries that we might consider. The first is a true product company. There's something physical. There's a widget that I can hold. a tech company, so things like software where there's not a physical product, it's intangible, as well as life sciences. And in there, you've got sort of the medical device space where there's a tangible product, and then you've also got the pharma development where it's a little bit more science R&D. Whenever you have a physical product, the biggest thing to understand is, one, how are they creating it? Understanding the supply chain and different supply chain risks, understanding how they're scaling production and the costs that go into it. And when you're talking more tech R&D type stuff, so that would be software, you want to understand basically, what's the tech stack that goes into it? What sort of technical risks are there? Do they have the right people with the right experience to move it forward? And when it comes to sort of pure science like pharma, really understanding the clinical trials that have been done, the independent research that has been done to date, as well as what milestones the company needs to get going forward. I find that most of the companies at Keiretsu that we see in the pharma space have at least some of their preclinical trials done and are usually raising money for their phase 1 clinical trials. So that's kind of a good space to be at for Keiretsu due diligence, but we've certainly seen companies on either end of that as well. The final big piece to this bucket is the IP, the secret sauce. And the biggest thing here is, now that you've evaluated how the company makes its product and what that product is, IP is really all about protecting that property. Without IP, a company is really worthless because anybody can copy what they're doing. This isn't always patents, and in fact, sometimes patents aren't the best choice for protecting IP. You've also got to consider trademarks, trade secrets, copyrights, making sure they're protecting themselves with NDAs and non-competes and all of that sort of thing. So really making sure that you understand the secret sauce, the moat, if you will, or the barrier to entry. All right, the fourth bucket here is really looking at that management and governance piece. So understanding who the jockey is.
Sorry, Nate, can I interrupt you one quick? Peter Wilkins wants to talk about valuation methods for pre-revenue ventures.
Oh, that's a great question. So when it comes to valuation methods for pre-revenue ventures, the one that I usually recommend, and a little bit of credit to Central Canada as members for introducing it to me first off, is the Berkus method. And if you look up the Berkus method, BERKUS, I believe, you'll be taken, there's plenty of posts about it on the ACA's website, other sites as well. But essentially, one of the easiest ways to value pre-revenue companies is essentially come up with a list of milestones that such a company might meet. So the Berkus method, I think, has 5 things like: do you have an idea? Do you have an experienced team? Do you have any sales traction with customers or any customer feedback? Do you have a product actually created to reduce the risk of actually product development? And so you can kind of come up with milestone buckets like that and assign a value to each of those. So perhaps if I have truly nothing, I'm worth 0. If I have an idea and it's a good idea and I've vetted it with experts, there's a value to that. If I've created an MVP and I have a demonstrable product that works, there's a value to that. If I have a lot of experience in the space, there's a value to that. And so as the company in the pre-revenue phase starts meeting more of its milestones, starts checking more of the boxes, you can hand wave some of the value question by saying, you know what, for each of those boxes that they check, I'm going to throw $500,000 on the valuation. And for the most part, that's a pretty good guesstimate of where the company's at, where the company can go. All right, so back then to looking at some management and governance questions. So there's really 2 pieces here. First is the jockey on the horse. You can have the best horse in the world, but with the wrong person steering it, you're going to crash and burn. So the first thing that we really want to look at is just who's running the company. Who is the management team? What experience do they have? In order of importance, I would say prior exit experience. If you've exited one company, you can exit another. Prior startup experience. If you've started one company, gone from 0 revenue to lots of revenue, you can probably do it again. Industry experience. So if you know the industry very well, you have connections within the industry, that's going to help you leverage your startup and exit experience to be even more successful in less time. So that's sort of how I would categorize the different levels of experience we look for in founders. Of course, trustworthiness, past history, making sure this is someone that you trust. Exit timelines, you can be in bed with a company for 10 years, 12 years. And so you really want to make sure that this is a founding team that you're going to trust with your money for the next decade. Similar to even getting married or something, you want to make sure you trust the person as sort of a bare minimum. You also want to look at the board of directors, the board of advisors, understand sort of who's in charge of the founders. Right, everybody always has a boss. And for the founders, for the entrepreneurs, their boss is the board of directors, representative of the investors, hopefully. So you want to understand how investors are represented on the board. Having an independent board comprised of industry experts is so important to the success of companies. It's definitely something that we need to be looking at during DD. just to understand who's sort of that last check. If the entrepreneur starts going off the rails, who's there to rein them back in? Who's there to advise them? Who's there to help them avoid those obstacles as they occur? Some of the other pieces that fall into this section, sometimes there's a site visit conducted if there is a site to look at, just understanding where the company operates out of. The other big piece here is understanding sort of that corporate binder, making sure that if an acquirer came knocking tomorrow, they'd have all their documents in a row ready to go. So maintaining adequate files is also kind of a big check the box moment of due diligence as well. The final piece of this is really just developing a communication plan with the CEO, making sure not only this is someone you trust, but that you trust to provide you with timely updates and involve you in an advisory capacity. Make sure that you're creating a communication plan before you invest, right? Once the company has your money, they're moving on to the next person. So use that leverage that you have prior to investing to really get the company to agree to a solid communication plan, to agree to kind of the next milestones, and make sure that then you're holding them accountable to it. So of course, as the process goes through, as we get through due diligence, as we go through each of these subject areas, red flags always come up. These are risky companies. There is always going to be a risk involved. And there's a few different ways that we can approach those risks. The first is simply discuss it with the company. Hey, I found a risk. I'm a little worried about it. Tell me how you're reacting to it. And if the company says, oh, yep, you're exactly right. That's a risk. Here's what we're doing to mitigate it. Great. Then they're mitigating the risk. It's perhaps not something to be so concerned about as long as you agree with their mitigation strategy. If you disagree with their mitigation strategy or they don't have a good response to the risk, it's time to discuss it with the rest of the due diligence team. Hey, group, I found a risk. Company didn't have a great response for it. How do we want to treat it? And there's a couple of ways that can go. The first is to say, well, it's a risk. It's not a deal-killing risk. Investors might still responsibly choose to invest. And so you simply highlight that risk in the report. Hey, here's a risk that we found. You should be aware of it. If it's a deal-killing risk, if it's a risk that makes it simply irresponsible to put out a report, nobody would possibly invest in the company, then it may be time to stop due diligence either until the risk is mitigated or until something else happens to remove that risk as a factor. So things like that, for example, if the founders have been convicted of fraud in the past, perhaps that's a deal-killing red flag where DD stops. If it's simply a risk of saying like, hey, we're going into a pandemic, we don't know what the market's going to look like. Well, there's ways that a company can work around that, continue to get into the market, continue into the go-to-market phase. And so that's a risk, but it's one that perhaps would not end a report, but would simply be addressed along with the company's mitigation strategy. As that report comes together, so as due diligence substantively wraps up, each person who's taken responsibility for one or more roles of the due diligence report will begin drafting their section. This can be an outline form, this can be narrative or prose form, really whatever format you're most comfortable being able to communicate your ideas. The biggest thing that we look for, though, is that we do want our reports to be factual. We want them to be rooted in fact so that the company can use those to share with others. We don't want the reports to be highly opinionated. And most importantly, the reports do not render an opinion on investability. We leave that ultimate determination up to the individual investors who are reading these reports. So just a couple of examples here as you're writing a report, things that you can do to make the report more useful to those future investors. Conservative financial model is a good one. That really doesn't tell me anything as an investor. Now, if I have a personal relationship with somebody on the DD team, I might know what they mean, but if I don't have a personal relationship with that person, I have no idea if their definition of conservative matches with my definition of conservative. Same thing for saying things like, hey, they have a superior product. Customers love their product. They're growing quickly. All those sort of weasel words, we want to try to contextualize those, add some facts around them, and actually just give the numbers. If I know, for example, that their financial model is growing at 2% a year, I can make a determination over whether I think that's reasonable or not as the reader of the report. So just something to keep in mind as those sections of the report come together. So as I mentioned, as that report comes together, as due diligence winds down, the different team members for the different sections of the report will draft their sections. So we'll have a sales and marketing section, we'll have a competition section, we'll have a financial section, we'll have an IP section. Those sections then all come together. They get reviewed by the company, and now the company is only reviewing for accuracy. The company shouldn't be putting their own words into the report. The lead then will review those reports, make sure they're cohesive, put them together into a final document. Oftentimes I default to that lead role. So my role is really to bring those sections together, compile them into a report, put some boilerplate on the front and back end, make it look good. I'll review it for kind of that objectivity, subjectivity that we looked at. And then everybody on the diligence team will have a chance to review that final report, make edits, make comments, add some suggestions before that report ultimately gets published and distributed out to everybody. Once the report is published, we'll hold a due diligence deep dive call for the companies. Sometimes the companies schedule these themselves. Sometimes they have us scheduled for them. But really the crux of these calls is that it's a chance for investors to talk not just with the company, but also the due diligence team members. It's a chance for the due diligence team members now to share some of that opinion that we didn't want reflected in the report. So these deep dive calls are quite useful. Typically, they'll start with just a quick recap of the deal by the company, and then we'll have some Q&A where investors can ask the diligence team members to share their thoughts and opinions and what they thought of the deal. Finally, as due diligence winds down, this company comes back for an update and starts raising money again. It's really time to put your money where your mouth is. If you've recommended this company, if you feel confident in what they're doing, and you're in the process of investing, some of the things that you want to look for, of course, as an investor, you're going to need the subscription documents. That's going to be your purchase agreement, as well as any other notes that go along with that. Also look out for things like the investor rights agreement or stockholder agreements. These are sometimes secondary to the actual subscription document and lay out other rights and preferences that you as an investor might have. You of course need the wire transfer instructions to wire money. And once you've signed all that, once you've confirmed your investment and paid the company, you're good to go. You're an investor. You're on that cap table now. Obviously, there's a couple of other alternatives to direct investing, often used. So SPVs, for example, let you come in with a lower minimum. Rather than having to cut a 25 or 50K check, perhaps you can write a 5K check, pool that with 5 other investors to meet a 25K minimum, for example. Also funds, so definitely Keiretsu Capital's co-investment funds. One investment into Keiretsu Capital gives you exposure to anywhere from 30 to 40 companies over the course of a couple of years. So definitely some alternatives as well if you like the company but want to look at a different avenue for investing. So I think that winds down that portion. I will launch one more poll as we get started with kind of our group discussion. If you are interested in participating more in due diligence or becoming a member of Keiretsu, please do let us know. But with that, I am going to stop sharing my screen, and we've got a few folks up. I see we've got Mike Graham, thank you for being here. Karen Howlett, as we mentioned earlier, and I believe we've also got Dan Collin. Yep, there we go. So I want to thank the 3 of you for being on. They're going to talk to us a little bit about their experience with due diligence, what they took away from it, how it's impacted for Dan and Karen, how it's impacted them as investors, for Mike, how it's impacted him as an entrepreneur. And then I'm also encouraged them to share any kind of tips and tricks that they have from an investor perspective, how you can make due diligence work better for you, as well as from a company perspective, how you can make due diligence more helpful for the company. So I think, why don't we do a little bit of a mix and match here. So I'm going to have Dan start, and then we'll have Mike in the middle, and then we'll wrap things up with Karen. I'm going to let you guys introduce yourselves because I think you can do a far better job than I can. But I will tell everybody off the start. Dan and Karen have been investors and members of several DD teams with us for a while, so they definitely know their stuff from a DD perspective. And then Mike, as I mentioned earlier, is CEO of Epilogue Systems, one of our company that just wrapped up due diligence. So his report is hot off the presses. So he'll be able to give us a very topical perspective of the company's experience. So all right, so Dan, I'll turn it over to you. And I think we've got probably enough time for a solid 5-7 minutes for each of you. If you just kind of introduce yourself, talk about your experience on DD, and any tips and tricks that you have for people.
Sure. Thanks so much, Nate. Thanks for inviting me. It's a great opportunity to share my perspective with everybody. I guess I'd start just by saying that doing due diligence has been one of the best parts of the experience of joining Keiretsu. As Nate mentioned, I actually wear multiple hats. I invest, but I'm also an entrepreneur. And so due diligence to me is a great opportunity, whether you're an investor, whether you're a founder, or whether you're just in the ecosystem providing services or whatever you're doing. There's something to be gained with any one of those hats on. For me, as Brianna always says, it's all about the relationships. And so the most valuable thing about the process is there's just no replacement for getting to collaborate with other people. So it's not only a chance to meet people, but to really work with them and get to know them in a deep way. That's really been fantastic. I've done 3 due diligences this year. They've been varied in terms of their duration and their intensity and the mix of people. And everyone has sort of offered me something different that I've taken away, including learning the process itself and developing the way that I think. So it's been fantastic from those perspectives. I would say that due diligence is interesting because it's kind of like a learning journey that you go on with the other people on the team, including the founder. And so it's tempting, when we work in business, to have really highly structured project plans with, dates and deadlines. And obviously due diligence is structured and organized, but it's also a discovery process. So what you find is that the back and forth between the company and the team often is a process of questions leading to answers that lead to more questions. And everybody's learning from that process. And when the process is going really well, as it did the last time I did this, the CEO is actually gaining as much or more from the process as investors involved. I know the last guy that we did it with was very appreciative and quite vocal in his appreciation. I think another key is just what you bring to the process. It's a classic you get what you give kind of scenario. So the more energy you bring to the process, the more openness you bring to the process, the more humility you bring to the process, the more you find that you get out. And I guess I would just close with sort of what I've learned are kind of my keys to success doing due diligence and being involved in the process. It's coming in with open eyes and kind of an open mind about what you're engaging in, recognizing that it is kind of a dynamic and somewhat elastic process sometimes. So you want to be clear about your commitment. You want to make a really strong commitment. And I think you want to be clear with others about what your so it's being clear about what you expect from the process and being clear with everybody else about what they should expect from you, and just being as clear as you can about your boundaries. So taking on the right amount of effort and focusing on things that you enjoy or you want to learn about, and being clear with everybody about what you're trying to get out of the process, as well as just producing a fantastic work product that helps everybody in the network.
Thank you for that, Dan. I really appreciate you kicking things off there. So we'll go to Mike next, and we definitely, I think we'll have a few minutes for questions of our panelists as well at the end. So if everybody wants to throw some questions in chat, we can save those for the end. So Mike, we'll have you go next, if you don't mind.
Well, thank you. And actually, I want to echo what Dan just said in terms of the benefits that come from this process. When you're in the middle of it and you're working really hard to get everything done that needs to be done, to make sure you do all the follow-ups and all that, you sometimes lose sight of that. But I have to tell you that if you walk into this as an entrepreneur, as a CEO, with an open mind, that the quality of the people that exist in this forum is just tremendous. And if you just sit back and listen to the questions they ask, and then start to understand why they're asking those questions in the way they are, it can lead to some wonderful dialogues. If I can share my screen just for a second, I just want to let you see, what became of our DD team, who was on it. And it's really fascinating because I think it was John just asked a question that some people might be discouraged because they aren't in a position to put money into this venture or whatever. And that's what we had here. There were several people here that were really upfront with me that says, I'm just not going to be able to participate now because A, I'm putting all my money into my own venture. B, I'm an entrepreneur thinking about presenting to Keiretsu, and I'd like to go through this process. And so it goes. And what I would say is to an entrepreneur, that Juan actually said this when we were talking about, participating in Keiretsu up front. He tried to really stress how hard you have to work, because lining up a quality DD team is not easy. You have to pursue these people, and you have to, present your value clearly for them, and you have to be willing to do some work. Norman Boons, who's out of the Northern California chapter, really put me through the ringer before he even decided to become a part of this. He probably submitted at least 25, if not 30 questions that he wanted to, perform his own form of due diligence just to commit his time. And certain of the others did the similar sort of thing. As far as the experience went, and advice I would give is that I would tell a fellow entrepreneur that they really have to organize themselves, because you cannot let a single person fall through the cracks, because you don't know what that person can bring to the party. And also you have to recognize the value that they might bring beyond just an investment, beyond just their participation in the due diligence process. I'll just there are several people here that fall into that category, but I'll just highlight Fabrizio Franco, who has had 30 years in our space, tremendous depth of knowledge, contacts, and his ability to spot elements of our strategy that might make sense to fine tune. And so I just had to listen to him. And yet he was completely against this investment when he came in, but he decided to come in, and he decided to leverage his skills to our benefit. And he thought that this process would die before it concluded, and he flipped 180. And the reason he flipped 180, and there were a couple of other people like that as well, is because you have to give these people the chance to ask their questions. And when they ask their questions, you've got to answer them. You've got to answer them quickly. And then you've got to create a forum to discuss those answers and then get their next layer of questions. And it was because of that and their willingness to go through those iterations, question, answer, meet, discuss it, question, answer, meet, discuss it. That was what really ended up, turning the day. So it was really the fact that these people were willing to put in that amount of time and skin in the game in terms of their time. And at the end of the day, I think that our company, my team, has really benefited from this process, because we have honed some strategy elements. We have had doors opened by due diligence team members. And we are actually in discussion with probably half a dozen other angel groups as a result of these people and their connections. So it's been a wonderful process, a much longer process than I anticipated. And I think entrepreneurs do need to understand that it is a long process. But I've taken institutional venture money a number of times, not in this company. And I would say that the experience and the amount of effort they're willing to do on our behalf has never been matched by a venture firm. So I'm pretty grateful. Organize yourself, though. Organize, 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 and stay on top of things. And don't be afraid to communicate, ad nauseum.
Thanks, Mike. I really appreciate that feedback as well. And I would like to add that to our yearly theme of communication. We'll have a sub-theme of organization. It is so true that communication and organization and not being afraid to share ideas and share thoughts and share feedback is absolutely how we're successful. So thank you, Mike. I really appreciate that overview, and I'm very glad to see that so many of the DD team are investing. All right, we'll go to Karen next. So Karen's led several DD teams, been on several DD teams, been involved with several of our companies. So Karen, we'll have you to kind of bring home the panel here.
Gee, thanks. Hi, I'm Karen Howlett, and I have been an investor with Keiretsu since 2018, I think. I've probably been on 6 or 8 DD teams. And I started volunteering for DD because I thought I was doing it to understand the companies, but it is kind of like any other volunteer experience. You always get more out of it, or at least as much out of it as you put into it. So besides understanding the companies, it does provide a great opportunity to get to know other investors and meet new people, and especially expand your circle of expertise and people you can go to ask questions when you come up with things in the future. So for me, investing in why would I invest in a company? And the first thing is the team. So when you're on the DD team, you're working closely with the CEO, so you get to know them much better than their 10-minute presentation a couple times during the Keiretsu process. But I also like to get to know the rest of the team at the company to see how do they interact with each other, what are their communication styles, all those sorts of things. And mostly, are they coachable? Are they willing to roll with the punches? Because these are startup companies. Things are probably not going to play out like they think they're going to. So you want to be sure that your team's able to adjust to the world that they're living in. Of course, with product, one of my thesis is that I don't invest in pre-revenue companies. It's just my thing. So I want to see product market fit, and I think the best thing to do that is through revenue. But I have learned from other people about how other people look at it. So that's a great example of things I've learned from other people on the DD team and other investors. But there's also some institutional wisdom that you should only invest in domains that you understand. And I've learned that my understanding is pretty narrow. So by getting to know more people via DD experiences, I'm really able to diversify my investments also. So I find that as a big benefit. When I'm looking at a company's business plan, of course, I'm looking at their financials, but even probably before that, you want to know what their target market size is. Is the TAM big enough to be worth the effort? Is the way they're going to market scalable? And importantly, what's their use of funds? Are they using it to pay off debt? Are they going to pay the founders? Those would be red flags versus how are they investing into growing their business. Then when it gets to the legal documents, I always ask for the feedback from the term sheet committee here at Keiretsu because I'm learning more about that, but that was not my expertise before I got here. So I want some people that have spent time specifically on the legal documents to give some feedback on what the company's looking for. And then how the entrepreneur responds to that feedback is also critical for my thought process and potential to invest. So some other things that I think have been successful or make for more successful DD teams is when there is a weekly meeting that the CEO drives. If it's just, well, get back to me when you can, those seem to lag on forever versus a very structured organization like we just talked about is key. And I think you learn a lot about how the company is run by how the DD process is run. I think those are the main things that I wanted to talk about. Like I said, the DD process has been very fulfilling for me. I enjoy it. I enjoy getting to know other people and learning more about the companies. I saw there was a question in the chat about investors. I do think that if you're on a DD team, typically you should be prepared to invest. I have been on a couple of teams that where I've not been in a position to, and I made it clear early on that, hey, we have some whatever going on in our life, so I'm not going to be an investor, but if you need some help with this, I'd be happy to, or whatever. And sometimes the team needs that support and sometimes they don't, but I think it's something that you should be upfront about, because I do think it looks bad if there's a published report and none of the, or very few of the team members have invested. That would be a red flag if I were not on the team. I'd want to know what's the real story.
Thanks, Karen, and I'll echo that as well. I think the biggest thing when you're considering whether to join a DD team, at least from my perspective, have something of value, I suppose, that you're thinking, whether that's your time and expertise in helping other investors understand the deal, or whether that's your check if you like what you see. I definitely think it's fair to say you don't have to invest after due diligence, right? That defeats the whole point of due diligence. But it's definitely, I would agree, the strongest due diligence teams are those that have a very healthy mix of genuinely interested investors and genuinely interested subject matter experts. Definitely make for a much more robust process. So thank you for that.
The other thing I do think is critical is just be honest with yourself about how much time you have to commit to the process, because I think the 20 hours is probably a minimum of what it's going to take to be on a DD team. So and if you're holding up the whole team, that's not a good thing either. So that's actually the first thing I ask myself before committing to a DD team is, do I have time to really participate in this or not? And that's on me to answer.
Absolutely. All right, well, thank you, Dan, Mike, and Karen. I see we have a couple questions in the chat, but I think those are probably, Mike and Karen did a great job of answering a couple of those already. There's a couple that I can answer from, I think, Keiretsu's perspective, and then perhaps Dan, Mike, and Karen, feel free to weigh in. And I also want to make sure if anybody has questions specifically for Dan, Mike, or Karen, feel free to chime in with those as well. As we collect any other questions, though, I'll touch on some of these. So in terms of incentive and recognition that DD team members receive, so these reports are all a volunteer effort, which is why they're so much more powerful when you have genuine investor interest or subject matter expertise that you can contribute. And at least from my perspective, the way I try to sell DD, I suppose, is really the benefit of getting to understand the company better to potentially take your investment from a 1x to a 7x. being able to expand your network and meet new people and learn new things to hopefully take future investments from a 1x to a 7x. And so I think there's a lot of benefits like that, at least from what I've seen that can be gained. Perhaps Dan and Karen, I think you both touched on some of the benefits you receive, but perhaps if there's any that really stand out to you that you might want to recap just for everyone listening.
I guess I would say, from an investment perspective, at the end of the day, there's just no substitute for firsthand. I kind of describe it laying your hands on the patient. You really get to see what you're investing in. And if you think about the way Wall Street works and all the time and energy that analysts pour into looking at companies, the kind of access and opportunity you have, as Karen was describing, and getting to know the team, getting to know how they think from working with them, there's just no substitute for that. And, so as an investor, I find that incredibly valuable. As I said, as a connector, I find it very powerful for getting to know people. And then there's just always opportunities to learn. So those, for me, at least, are the biggies.
I would echo that. I was thinking the same thing as your relationship with that team doesn't end when the DD process is over. You still know those people and they're available to bring you up to date. If you have a question about what's going on in the company, they're more likely to take your call and be upfront with you. I've also developed relationships where I can ask about other companies that might come through that they might have some expertise in and stuff. And that was another thing. Another thing that I didn't mention, but we do try to do on the teams I'm in, is try to find some references outside the ones that are provided. Of course, if somebody's providing you a list of references, you hope they're going to say nice things about them, right? So you try to do some networking and find people that know them outside the process, so you can maybe get a more clear view of how they've interacted in other situations.
Fantastic. Well, thanks, Dan and Karen. I see we've got another question in the chat here, speaking to investment performance of companies that have gone through DD versus not gone through DD. And I think that's a really good question. So one of my other roles here at Keiretsu is as portfolio manager for the Keiretsu Capital Funds. And as such, I see a lot of the companies over time that have been through DD. We've got just over 100 companies, all of which went through DD, all of which got some level of Keiretsu investment. And I do find that they seem to have so far much longer kind of survival rates, or much higher survival rates, much lower failure rates compared to typical exits. Of the over 100 companies or so, only about a dozen have really outright failed. And so I think that's really highlighting the impact of DD as a filter, where it lets us filter out the companies that perhaps aren't as likely to make it, and helps us focus in on the ones that are. And hopefully, of course, with Epilogue's complete DD, hopefully, Mike, we get to see you on that list as well of companies that are doing very well and giving us nice returns in a few years here. I think that's probably a good note to end on. So I want to thank everybody for taking this hour to spend with us.